Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Supermarket giants are again in the headlines after an interim report into competition policy recommended massive fines, or the potential for massive fines, for chains that abuse market power. The review of the Food and Grocery Code by economist and former Labor Minister Craig Emerson rejected calls from the Greens and Liberals to break up companies doing the wrong thing. Instead, it proposes a mandated system to replace the current voluntary code of conduct with penalties of up to 10% of annual turnover. For giants Coles and Woolies, this could mean some of the largest corporate fines in Australian history. All theory at this point, mind you. I wanted to take a look at these big players with the help of someone who spends a lot of time analysing the retail space. Remember, this is general information only, and you should seek professional advice before making investment decisions. Ben Gilbert is the head of Australian research at Jarden, leading their research team and consumer sector coverage. Ben, you're almost a regular at Fear and Greed now, I reckon.
Thanks, Sean. It's always good fun being on here.
Good. So just at a very high level, tell us why Craig Emerson did the report, and then just, at this very early stage, what you make of the recommendations.
Yeah, so I think it's important to sort of start off saying that this was a scheduled review. The Grocery Code of Conduct was introduced into Australia a number of years ago, and it was due to be reviewed at this period in terms of effectiveness and potential changes to move forward. And that's what we've seen in terms of the draft report that's come out today. The other thing I think is important to note too is that there's a number of other inquiries that are happening at the moment, around 10 at our last count, that are separate to this. So these are the Senate inquiries, these are the ACCC inquiries, etc. So there's a lot happening in the space. In terms of this review specifically that we've seen today, look, this goes through a number of recommendations, and the key one is that the code be made mandatory for retailers that are turning over $5 billion a year. And then there's a number of recommendations, effectively trying to make it easier for suppliers to come through and talk to potential issues or claims that they might have without fear of retribution. And I think ultimately that feels to me to be the goal of what the recommendations are being put forward. As you said, there are some pretty significant numbers talked to in terms of scope for fines. It's important to remember these are all recommendations at this stage, but you have sort of tried to recommend putting some increased powers in for the likes of the ACCC, etc. as well. So this is the report that's come out today. And then obviously we sort of see where these recommendations move towards after a consultation period over the next month or so.
Do voluntary codes of conduct work with big business? It seems like the government has come out and said, well, it said broadly it thinks it will adopt these interim recommendations. The Prime Minister said that. However, it's this voluntary versus mandated thing that goes on in all sorts of sectors. Do voluntary codes just not work?
Well, it depends how the volunteers engage with them. And I think the important thing to understand with the code as it sat before this is that the major retailers were signatories to it, so they'd committed to it. So while it's voluntary, they'd come out and they'd committed to the code. So as a consequence is that they were abiding by the code, and you have seen changes in behaviours. There's been things around how you can or you can't that reclaim things like shrink being sort of wastage, theft, or damage. So there has been a number of changes. I think that the concern or the question that's come out of it is, have people who have had issues that might be a contravention of the code been comfortable or confident in their ability to come forward and raise these? Yep. And if they did, was there fear of retribution? And I think that's ultimately what it's come down to. And the report and the recommendations that have been put forward are really trying to sort of make it easier or make the penalties larger or more incentive to come forward if there is, and reduce that fear of retribution. And you'll see within there too that it's talking to giving the ACCC some more involvement and power in this as well. Now, the ACCC has also got another inquiry going on with the grocery side of things at the moment as well. So there's a lot that's happening in the space. There's a lot of discussion around what can and will come with respect to regulation. And it just, I think, so happens that the review of this coincided with a number of Senate inquiries and a government inquiry with respect to the ACCC.
Okay, so let's talk about some of those inquiries. The ACCC one, it's looking at allegations of price gouging by the supermarkets. Is that something that you think the supermarkets need to worry about?
Look, I think it's important to remember that we're a consolidated grocery market in the traditional sense of the word. So if you walk into your local shopping centre, you might look around and see a Coles or Woolies and an Aldi. Maybe you see a Coles and IGA and an Aldi. Or maybe you see a Woolies and a greengrocer. But the other thing that we're seeing now is that, yes, we do seem to be consolidated. But when you walk into a supermarket, a shopping centre now, you might also then turn left and go into your local chemist warehouse. You might turn and walk outside and go into a pet barn. You might sit in the store and say, okay, well, my nappies that I was going to buy, I could buy these on Amazon for $5 cheaper today. Bang, I'm going to hit that and it's going to be delivered on Prime in 2 hours' time. Maybe not quite 2 hours, but could be as. So the backdrop is much more competitive as we see it today. Now, sorry, to go to your question around specifically, is there price gouging? Well, look, profitability in Australia is a touch higher. But at the same time, the Australian retailers are putting an enormous amount of money with respect to CapEx back into the industry. And when I say CapEx, I mean that when you walk in and see a shiny new supermarket with a nice fresh aisle, or you see all the lights in your health and beauty, when you go in and you want to do store to boot, that all costs money. And you've got to put infrastructure in around that. So as a consequence, that while margins in Australia might be a touch higher, the returns that the retailers are earning on the capital that they're putting in, i.e. the dollar of profit for every dollar they invest, is actually not necessarily as good. So there are a number of dynamics, and it's pretty complicated and discussion, but I don't think that they're price gouging per se. I think the market is competitive, and I think the market is becoming more competitive by the day.
Stay with me, Ben. We'll be back in a minute. I'm speaking to Ben Gilbert, Head of Australian Research at Jarden. Okay, so if you bring this back to an investment thesis, what does the outlook for Coles and Woolies and Metcash, the big supplier to IGA, what is the outlook for those guys?
Well, look, I think if we take a step back and think about if you're an investor sitting there looking at anything you're going to put money into, be it a house or a share or whatever it is, you're going to want some sort of level of certainty. Yep. And uncertainty, well, it can be some investors' friends. Uncertainty is always a challenge. And I think that's why you look at the supermarkets at the moment in Australia, and from a relative basis in terms of valuation, they're looking quite cheap. Now, the question is well, what's to come? Are we looking into risk of further regulation that could impact profitability? There's obviously a lot of chatter which is being dismissed largely around potential laws with respect to breaking up. We see the news around the scope or recommendations around the size of potential fines today. All this creates uncertainty. Fundamentally, we still like the grocery space on a longer term lens. We think it's attractive. We think that they're good businesses, they're run well, and that they've been investing in a lot of areas that will drive scope for alternative profit levels of profitability. The question is just navigating this near-term uncertainty. And what that means is that we've got to really see how the next quarter or so unfolds to see where the recommendations come with respect to the ACCC inquiry, see what comes of the Senate inquiries, which will mean that there's probably still some risk around near-term volatility in the space. But fundamentally, we do think that they're good businesses that will sort of wear the test of time and come out in a strong position. But, as I said before, there is more competition. Look at things like Wesfarmers, as I think we've spoken about it on here before. They're doing some great things across their businesses, but walk into a Bunnings now, you can buy your pet food, you can buy your cleaning products, and they've got a lot of space.
Yep.
The more space that's allocated, the more turnover they're generating generally.
Mm-hmm. Yep. Do you think part of this is it's almost cyclical? A few years ago it was the banks. Certainly last year it was Qantas. Now it seems to be the supermarkets. And at some point the news cycle will move on from the supermarkets and it'll be someone else?
Yeah, look, if we take some lessons from offshore, you've seen a lot of debate around grocery pricing in a number of markets offshore. So you can look to France, you can look to Canada, you can look to the UK, you can look to a lot of markets. And there was a lot of discussion around, look, do we create price caps? Do we put restrictions in around pricing and promotions? Ultimately, what they found is that putting those sorts of restrictions in can have impacts around competition and companies willing to invest in market. And what we saw is then as time went by is that some of the pressures that were lifting prices, notably a lot of the flow-on effects from COVID, and then more recently some of the geopolitical issues around supply of wheat, labour, shipping, all these sorts of things, when those normalised, which, look, there's obviously still some volatility, but food prices came down. And we're seeing that in Australia at the moment. You look through the supermarket at the moment, I think you're seeing more promotions. You're starting to see some more price cuts. And I think as we continue to see food pricing moderate, I'm talking dry here because fresh is a little bit different, I think that should take some of the heat off the sector. But look, we had an inquiry in Australia in, was it 2007-8? This is sort of part of the course, and I think it's always important to review these things and give the consumer ultimately confidence and all those stakeholders in the industry, keep them accountable.
Ben, I'm going to throw a left field question. It's got nothing to do with supermarkets whatsoever. It's Treasury Wine Estates. Since we last spoke, we've had the tariffs reduced from China or cut totally in some cases. We've had Treasury come out and really push its premium brand in. There's talk in the media over the last 24 hours about them splitting off some of their lower priced brands. How do you think Treasury's travelling at the moment?
Look, I think Treasury's got a lot going on in its business. We like the story. I think that the opportunity around China and China opening up is material, as we've seen in the past. And what that means is it's also going to create some tightness of supply globally with Penfolds in terms of the supply-demand balance. And Penfolds is an absolute powerhouse. I don't think you'd meet anyone in the liquor industry globally that would deny that. So to open up that market, create that pricing tension, will, I think, ultimately improve the outlook from both a top line and a profit standpoint for that brand, give it a longer outlook in terms of earnings growth. And we've upgraded our numbers quite materially at the EBITS line for fiscal 27, 28 onwards for that brand. So that's a big positive. And I would argue at the moment the market is undervaluing Penfolds within the group. You then touched on the premiumisation story. Look, that's a big story globally in liquor. You can see it happening in tequila, you can see it happening in wine, you can see it happening all over the place. And you want to be in that premium space because there's a greater propensity for people to spend and there's a greater propensity to keep pushing your price up. If you're selling a commoditized product, you've got to be the cheapest and it's hard to make good money. Now, the demerge piece, I think, is an interesting one that you touched on. And as you said, there's some more press around that today. Look, this is all about, I think, sort of maximising value for shareholders and putting forward what is an optimal business structure. And as I sort of said before, you want to be in luxury and premium or luxury because that's where you can typically command better pricing. And from a market perspective, you typically pay a high multiple for it. So it can be accretive to share price. So look, I think it all makes sense strategically. The question is how do these unfold and what structure does it look like? And I think we sort of saw in the press today, so Tim alluded to, we'll get a bit more colour by the end of the year in terms of how that unfolds.
Ben, thank you for talking to Fear and Greed.
Thank you very much.
That was Ben Gilbert, Head of Australian Research at Jarden. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.